any indicators. I used to look at moving averages, but I strictly deviated from moving averages as well. And now I just look at if the market is trending, if the market is consolidating, or if the market is heading down. Those are the only things I look at. So let's say first off, you have an uptrend. You have an uptrend. In uptrend, what's going to happen is price will always make highs. This is really important. Whenever price is trending up, it's always creating highs. Its price went up, price made a high. Whenever price makes a high, there's an 80% chance that that high is going to get retested. And in uptrends, candles will always make higher highs and higher lows. So sometimes, like, when you watch some videos or when you open some books, you see that, okay, guys draw like, okay, so this is an uptrend here, price making higher highs and higher lows. So you have a high over here, price made a low, then price made a higher high, price made a higher low, and price made a higher high, yada, yada, yada. But when you're zooming into the charts and when you're zooming into the candles, you're looking to see that, okay, if price is coming down to support, now notice this, right? Let's take a look at this candle right over here. Let me just remove these arrows and let's look at this candle right here, right? Candle, now see, this candle had no wick at the bottom, so this means there's no range for the next candle to go down, but we don't know because it's a 50-50 chance, it's very difficult. The next candle formed bearish, it had no wick at the bottom after price created a high. So then you have a candle closing bullish. If a trend is bullish, candles will make higher highs and higher lows. This is really, really important. For price to continue moving bullish, this candle has to respect the previous candle's low, and that's the only way prices continue moving bullish, right? That's a very basic definition of an uptrend, that candles will always make higher highs and higher lows. Next, we're going to talk about consolidation. Consolidation is when price is just moving sideways. Whenever you have candles that are printing side by side, that's consolidation. Whenever you have consolidation, it's really hard to say where price is going to move, unless you're looking at the higher time frames, which we're going to look at later on. But the most important thing is that for you to identify consolidation, right? When you have candles like, let's say, consolidating like this, basically you're saying that, okay, so we're forming resistance here, but we're also forming support in here. So for you to wait for price to move, you'll have to wait for a candle to break out of this area and maybe close a bullish candle, something like this. Because if you have a bullish candle closing like this, now you can look back and say that, okay, we had one candle that broke above this resistance, and now it made a higher low and a higher high. So now there's a very high chance that the next candle is going to continue making higher highs and higher lows and continue moving up. And that candle is going to be your trading candle, right? That's where you will say, okay, I might want to buy over here and leave a stop down over here and continue moving up. Now we're going to talk about this later on here as well. Now, in the opposite spectrum, when price is ranging, and someone can say, oh, well, if price is ranging, let me get a better color over here. Let me get blue. So someone can say, okay, let's say if price is at resistance here, and I'm going to try to trade a range, and I'm going to be a cowboy, and I'll try to trade a range, and I'm going to take a sell from up over here to go down to support. Now, that's a very valid idea, but the problem here becomes now you're trading in the range. Now, here's the thing. When you're trading in the range, the probability of success is low. Right? When you're waiting for price to go in an uptrend, or if you're waiting for price to go in a downtrend, the probability of the win is going to be much, much higher. So you have to put yourself in the very best position to win. So when price is up over here and you try to take a sell, now you're taking a sell in consolidation. This does not make any sense. Of course, you might win at times, but I've seen majority of the times people lose when they trade in ranges. And that's a very bad place to be, because when you're trying to trade in a range, even though if you're a good trader, now you're taking on a loss. You're taking on a potential risk that may turn into a loss, and when that trade turns into a loss, that affects your psychology, that affects your ego, that affects your confidence, and overall, you're just like, man, this is just so hard. So the best thing to do is to wait for price to come to support and actually break below the support. Because once you have a break, now you know that, okay, price has now broken support and created a low, right? Whenever there's a low formed, there's a very high chance price will retrace, create resistance, and then continue moving down to retest the low and eventually making a new low. Right? That's very important. So never ever trade in a range. That's very risky. I normally don't trade in ranges at all. If price is ranging, I wait for a breakout. Or if I wait, like let's say if price is going to be at this resistance, and if you have a break above this resistance, now you can say, okay, now price is making a high. So whenever price makes a high, just like right over here, you know there's going to be some sort of a retracement, will form a support, and then candles will start making higher highs and higher lows. So whenever you're looking at the charts, I don't want you guys to look at the charts from a very zoomed out perspective. I want you guys to look at the charts zoomed in like this, where you can see the candles. You know, because if you can't see the candles, you can't trade. Because what's this? If the consolidation is on a higher time frame, trade on a lower time frame. Yes, so we're going to talk about that later on too. Okay, so let's move on to the downtrend. Now, downtrend is basically when price is creating lows. You know, whenever price is making lows, this means that there's going to be some sort of a retracement, and then there's going to be some sort of a resistance formed. So now how these resistances are formed, we're going to talk about this later on here in the presentation, but mostly I want to focus on the downtrend. The downtrends is when price continues making lower lows and lower highs, you know, and that's a basic trend that you see on the chart. So if we were to map this out, we could say, okay, price made down, made a low, made a lower high, and now it made a even lower low. But when you break it down into candles, you're looking at specific candles. You know, you're looking at the fact that, okay, we had this candle here. The next candle made a lower low and a lower high. The next candle made another lower low and a lower high. So now we've made a new low. You know, so once price makes a new low, there's always going to be a retracement. There's always going to be a pullback. You know, so when there's a pullback, you're waiting for the pullback. When the pullback happens, you're waiting for another bearish candle, which will be right here. And when you see a bearish candle here, now you can say that, okay, since we're in a downtrend, and since this is let's say a 1 hour time frame, and we have a bearish candle forming, now there's a very high chance that the next candle is going to be bearish as well. You know, so now you can say, okay, the next candle was bearish. It made a lower low and a lower high. The next candle was kind of like a weak bullish candle, but it also made a lower low and lower high. And then eventually, we had a candle moving down, right? So there's a big difference when candles are trending bullish and when candles are ranging and when candles are trending bearish. You know, in ranges, candles will move sideways, where you see candles print side by side by side by side. When candles are moving bullish, you will see candles will make higher highs and higher lows. And when candles are moving bearish, you will see that they will make lower lows and lower highs. You know, so we talked about market sessions, different market sessions, how pairs are correlated. We talked about what times to trade, and now we're talking about what different ways does the market move. You know, this is the first thing I really start to focus on. I start to focus on that, okay, if I'm going to come to the charts, right, I want to see something making a high, or I want to see something making a low. There have been a lot of times, you know, when I come to the charts in the morning time and I see that the GPJPY in New York is just falling down, you know, is extremely bearish, is falling down, and I look at that as a good thing. Because if I see something is falling down, I know the trend is down. You know, so now I'm not going to try to sell when something is falling down. I'm going to wait for price to create like a minor resistance, and then I'm going to try to sell to retest the low. You know, this is really important. When you come to the charts and you see that price is just like, you know, forming side-by-side candles, this means that price is just ranging. Ranging does not help you. This is a bad way to trade. This is a big no-no. Someone asked a question, even though I said that all the questions are going to be answered, the question is, oh, I guess they lost the question there. So anyway, so we're going to answer all the questions in the very, very end. Save all your questions. All the questions are going to be answered as we move along. If there's something left, you can ask them in the very, very end, right? Because